Welcome to our Egyptian Online Seminar group. First, keep your microphone off. Then, if you have any questions, you can ask our speaker during his presentation. I have great pleasure of welcoming Professor Joseph Schroeder. Joe is an associate professor of accounting at the Indiana University. His research examines the impact of auditing on financial reporting and disclosure quality, as well as the impact of regulation on the editor client dynamic. His works has published in top-ranking journals such as the Journal of Accounting and Economics, Journal of Accounting Research, the Accounting Review, Contemporary Accounting Research, Review of Accounting Studies, and Auditing, a Journal of Practice and Theory. He is an editor of Auditing, a Journal of Practice and Theory. He earned his PhD in accounting from Michigan State University. Now we will start our seminar with Professor Joe.
Hi, I just want to start off by saying thank you to Mohammed for inviting me to this online seminar series. I've been seeing all the different posts, and it's very exciting to see that everyone here is putting together this online series during these uncertain times in the pandemic to bring people from around the world together to share research collaborations and build relationships and friendships and stuff. So very happy to be invited to share a paper that I've been working on for the last couple of years that I'm very excited about, and it's entitled Audit Process, Private Information, and Insider Trading. This paper is co-authored work with three of my good friends, but also colleagues. So Salman Arif, who's at the University of Minnesota. He was originally at Indiana University with me, and we got to work on a few different papers together. John Kepler, who recently just joined Stanford University after finishing his doctorate from Wharton. And then Dan Taylor, who is a professor at Wharton, University of Pennsylvania. I always like to kind of start my research presentations with a little bit of backstory of how did this paper come to being? And it's kind of an interesting story. So I had known Dan Taylor kind of casually through various conferences that we had gone to together. And we both went to the PCAOB research conference that typically occurs every October. And when I got in there, the only table that had seats still available was right by, Dan Taylor. So I ended up sitting next to Dan, and we just started talking about our respective research interests. So Dan had asked me what I do, and I started telling him about my work on my dissertation and some of the different papers that came out of my dissertation. And I started talking about, audit timing and when the audit is complete and finished, relative to earnings announcement disclosures, and just kind of explain the whole process of how it works. So through that conversation, I kind of mentioned that, auditors are having ongoing conversations with management throughout the audit process. And then during year end, the audit is complete, which is signified with the audit report date. And at that point, what the audit opinion content is going to entail. However, that audit report is not going to be released until the 10K filing to the public. And then Dan goes, whoa, wait a second, hold on. I do insider trading information or research, and I look at situations where management might have private information. And do you think that management's trading on the fact that they know what the content of the audit report is before investors know about it when it's released with the 10K? And it was at that moment that I kind of sat back and I go, I truly hope they are not, right? And Dan says, well, that sounds like a pretty interesting research question. So let's get together in 4 months. And then 4 months later, we got together and we pulled Salman and John into the team, and it's been a great ride since then. So I want to just make sure everyone's on the same page of like the timeline of a typical audit and how this works internationally, but also in the US setting, which is the setting that we're exploring. So throughout the audit process, so throughout the year, audit planning typically occurs right after the end of Q1 in the summer months. We always say on a calendar year, that would be May. In audit planning, you're coming in, you're assessing risk of the client, and you're trying to formulate your audit plan for the year. Then during Q2 and 3, you're going to be doing internal control testing. Sometimes in Q3, right after September, you'll start doing interim substantive procedures from an audit standpoint. And then we circle to year end and how this all works. So right after year end, you have year end audit procedures that are occurring. These are the substantive testing, the bulk of the audit procedures that you're doing to certify the year end financial statements. Now, while that audit is going on, you're going to have an earnings announcement release. So companies typically release a earnings announcement. This earnings announcement does not have to be audited, but companies still release this earnings announcement to stakeholders so that they have this information, in a timely fashion. Now, what we've seen since 2004 is that earnings announcement is going out before the audit is complete. But nonetheless, auditors typically have a discussion with management right before the earnings announcement comes out, and they tell them kind of the status at that point with respect to their audit. And then at the audit report date, when they complete the audit, so the audit report date signifies the end of the audit, they're required to have certain communications with management, board of directors, audit committees about the results of their audit. And in that conversation, they're going to be talking about the content of the audit report. Now, in most cases, that could be an unqualified opinion, but there are other cases where there could be additional explanatory language that's included. But those communications are occurring at the audit report date before the audit report is disclosed to the public. So what we contend here in this timeline is that managers and directors know the audit results and contents of the audit report before the general public. And this is just an artifact of the audit process and regulatory timeline. This just happens by the very nature of the way it works. Now, it's interesting. Most companies in the United States of America have instituted a voluntary blackout period for insiders. And what that basically means is they recognize that management and board of directors and audit committee members have access to private information right after year end before the 10K is filed, and they tell them to refrain from trading. Now, typically the way this works is those blackout windows go to the earnings announcement date. However, what we contend is that there's still some material, non-public information that relates to the audit process that could potentially give management a private information advantage. And that's ultimately what we're talking about here is, based on this figure, we know management and directors have private information. We believe that it is material information because it relates to the audit report having additional language that is not known to investors yet until the 10K filing. And the question really comes to, are they doing it? Do corporate insiders exploit this information advantage from the audit process for personal gain and then trade on this private information about audit findings? So from a construct level, we're basically looking at private information from the audit process, this advantage, and does management utilize that information for their own personal gain through corporate insider trading practices, which means they're trading on information before it becomes publicly known. How do we operationalize this? Well, from an operational standpoint, we are looking at differences in audit opinions. So audit opinions that contain additional explanatory language, modified opinions, that would include, for example, internal control weaknesses, that would include discussion of potential restatements to the financial statements, that would discuss changes in accounting policies and whatever, versus the unqualified opinion or the unmodified opinion, which is just the traditional 3-paragraph format. And then how do we operationalize our dependent variable? Well, we look at insider selling. Are they likely to be selling stock during our window of interest? And then we look at the insider buy-sell imbalance. And what we're essentially doing here is we're doing a short window event study around the audit report date. So we're using the audit report date as a proxy for when this communication of the audit results is finally communicated to management with 100% certainty on that audit report date. And we're trying to see, do we see any change in trading behavior around that communication event that would be signify that management might be exploiting their informational advantage. So why is this important? Well, I think it's important because any situation where management has an information advantage, it could potentially hurt investors, right? The whole purpose of the SEC is to level the playing field. The whole purpose of the Securities Exchange Act of 34 and the Securities Act of 33 was to put in safeguards to make sure that everyone has a level playing field and nobody's taking advantage of information and capitalizing on that. So what we're simply asking here is, this is a situation where management might be able to have private information, and we're kind of doing an investigation. This isn't really the old school theoretical approach to accounting research. We're asking a rhetorical question and just saying, is the evidence consistent with it or not? So we're looking here to see if the information advantage from the audit process could potentially hurt investors. We're also putting forth a little bit more nuanced view of the audit process. So I'm pro audit. I love audits. I think audits provide great value to society. But by sitting back and re-examining the way this audit works and how it manifests informational advantages, it's important for us to understand and consider that going forward, so that we might be able to put certain things in place, or at least inform, corporate counsel of, general counsel of companies or their governance mechanisms to be aware of the fact that, hey, by the way, there could still be some private information out there. The other thing is establishing that the audit report date is actually an important informational event that can be predictive of future things. So at the end of the paper, we show the fact that this audit report date and the insider trading around that report date is predictive or indicative of future restatements and also other events as well. And then maybe have a discussion. Should voluntary blackouts extend to the 10K filing, or should at least corporate counsel be aware of the fact that there could still be material information there? And then the last thing is the PCAOB has just started the expanded audit report. So the content of that audit report is going to contain much more information than was ever provided before. So with that increase in information content that's being disclosed, management would have even more of an informational advantage potentially. So it's important to look at these results, put them into perspective, and think about what we need to be doing from a regulatory standpoint to make sure that people aren't taking advantage of it. So what are some of the prior research out there related to our study? Well, we have research that's looked at modified audit opinions. And what we mean by modified opinions, and we actually dropped going concerns here, so I'll talk about that later in our research design. But internal control weaknesses, which would be like a material weakness opinion, changes in account policies, restatement of prior financial statements, or any other matter of emphasis. Now, what prior research has shown is that modified opinions typically are associated with negative market reactions. The market will react negatively to additional modified opinions. Modified opinions are also associated with higher cost of capital. So if you receive a modified opinion with this additional language, you're typically paying higher interest rates or having higher cost of capital in terms of equity. Last thing here is Chersney et al. Paper in the Accounting Review. What they found was that companies that release a modified audit opinion, if they receive a modified audit opinion, it's associated with increased likelihood of restatements in the future, which would indicate that these additional paragraphs are associated with something going on in the company that manifests in a restatement during future periods of that year's financial statements. There's also research that's been looking at the audit report date. So what I mentioned before is a lot of my work is in the area of kind of the timing of the audit in relation to the earnings announcement, and whether the earnings announcement comes out before the audit is complete, and what that has on management's disclosures decisions, the quality of financial accounting, the auditor-client relationship. Those are the things that I look at. This paper speaks to that in some ways, because we're sitting here and saying that the audit report date does matter. And oh, hold on a second here. I think
yeah, I think you need to reshare your screen. I think somebody else shared their screen.
Okay. All right, let me bring it up real quick.
Sorry for that.
Oh, you're fine. All right, here we go. Okay. So the audit report date, is signified by the PCAOB to be the end of the audit. We're speaking to that literature as well. Some additional prior research on insider trading. I want to first make sure everybody understands the securities laws in the US. It is illegal for insiders, and that means management, directors, or anyone that possesses material non-public information to trade on that material non-public information. This was established in the Securities and Exchange Acts of 33 and 34. It was updated again with the Insider Trading Sanctions Act of 1984, as well as some additional Insider Trading and Securities Fraud Enforcement Act of 1988. So if you possess insider information that is material and it's not public, you cannot trade on that information. It's against the law in the United States. What we typically have seen in the prior insider trading literature is that corporate insiders place trades based on superior information. So they're profiting or they're avoiding losses in situations because they have this private information. And when this typically occurs, we find that it occurs with poor accounting quality. So companies that have worse accounting quality or weaker governance, so an increased opportunity to do these types of things. That's where we see corporate insiders taking their advantage to the extreme. And the thing is about the insider trading literature. So our personal view as a team is that we think that we're making a greater contribution to the audit literature. But we're also making a contribution in insider trading literature because, prior research shows that insiders extract, rinse, and opaque information by weak governance, but they are not able to actually pinpoint the specific source of the informational advantage and whether they're exploiting it. So in this study, we're unique in the sense that we're able to sit there and say, we think that this is due to the audit itself, and they're using this informational advantage related to the audit to their own personal gain. Now, there's 3 related studies that are, I think, that we're building on with this, current study. So Huddard, Key, and Shee, what they do is they look at insider trades and whether they predict returns around the quarterly filing. Okay, so looking at insider trading activity right after year end, right before the 10Q or 10K filing, and then discerning if this trading behavior is consistent with the information that's conveyed in the 10K and 10Q. And what they're trying to say is that this insider trading would predict it, so they must be, using their own personal information. But the problem is with that study, we don't know what the source of that information is. We don't really know who is trading and whether it is audit related. So while they show that there's this association, they don't really have any causal evidence as to what's driving it. Scaife, Veeman, and Wangren, their 2013 paper in JE, what they're basically doing is they're looking at companies that have internal control material weaknesses. Again, companies that have bad internal controls would be consistent with weaker governance and greater opportunity. And what they show is that companies with weaker internal controls, and they're calling that tone at the top, there's this informational advantage, and they show that those companies are more likely to engage in insider trading. However, they do not examine the source of the informational advantage. So again, they're not able to really pinpoint a cause for it. They're just showing companies with weaker internal controls are more likely to insider trade. And then number 3, Hallman, MD, Kim, and Pereira, 2019 in AJPT. They look at going concern opinions. Okay, so we don't look at going concern opinions in the study. We've actually excluded them. There was a small amount of them to begin with. But they look at going concern opinions. And they show that insider sales rise 2 years prior to a going concern opinion. But then when the going concern opinion comes out, they stop trading. So the large thought process here is that this is a company that will eventually get a going concern opinion that might be going bankrupt. They're having financial difficulties, and management's getting out of it before the year or the period that they get the going concern opinion. And they attribute the results to litigation risk minimization because they're getting out before the disclosure is more salient or transparent. So instead of trading in the year of the going concern opinion, they trade the year before, and it makes it harder to pinpoint that they were doing anything nefarious. So how are we different with this study? Well, we contribute to the literature by identifying that audit process provides novel source of insider private information. So we're trying to put forth that idea into the literature. the timing of when insiders trades on that information. So we're able to use the audit report date to signify this is an event when private information is communicated to management and the board. And then we're seeing if they're trading on that date. So this is an event study. And we're also able to look at who trades on the information. So if you see in the paper, we look at, is it the executives? Is it the board of directors? If it's the board of directors, who on the board is doing it? And that's very important, I think, contribution to the literature to understand. We also hold information environment opacity and corporate governance constant, by including, firm quarter fixed effects and all this other stuff to show that trades occur around the audit report date. We're actually able to provide some really, I think, good causal evidence that this is happening. And we're also able to show that insiders trade are based on private information about audit findings by showing that trades are more likely for modified opinions relative to unmodified opinions. So what's our sample? We use years 2003 to 2015. We start in 2003 because we want to be post the Sarbanes-Oxley Act of 2002 to make sure that we have consistent regulations facing these companies. And then we end in 2015, just by the nature of when we started the project a couple of years back. The intersection of the following databases. So we're using Thomson Reuters for the Form 4 to figure out insider trades. We exclude options from that. We use CRISP to look at market returns. We use CompuStat to get certain financial information related to the client, the whole constant. And then we use Audit Analytics to identify the audit report date, but also the content of the audit report itself. What's our criteria for the short window event study around the audit report date? Well, we're making really strict criteria to be included in our sample because we're trying to get at more causality with our research design. Now, if we relax these assumptions, well, that's great. We can get a larger sample, but we're not going to be able to really pinpoint and say that it's the audit because you're putting in a lot more noise in that. So some of the things that we require, well, first, the earnings announcement has to occur after the audit, before the audit report date. Sorry, that's a typo there. And the audit report date has to occur 10 days before the 10K filing. So that those 10 days before the 10K filing, we need to make sure that we're picking up the trading activity and information related to the audit report date and not necessarily the 10K filing itself. Going through this, we have a total of 1,948 firm year observations.
Joe,
here is the, what's that?
Can I ask a question, or would you like?
Sure. No, absolutely.
So, can you elaborate a little bit more on the audit report content? You said that we are looking at what is included in there. So what exactly are you looking at? Are you just looking at the overall opinion? Do you look at specifics? What exactly is in there?
Well, so there's four types of opinions, right? So there's an unqualified opinion. There's a qualified opinion, which means that your financial statements are not in accordance with GAAP, but it's not like really, really bad, but there's like one component that's not in accordance with GAAP. There's an adverse opinion that says everything's bad. And then a disclaimer of opinion is I can't really perform the audit because I'm not independent or they don't have documentation. Now, for US public companies, you cannot issue an audit report on a publicly traded company. You cannot file your 10K filing unless you have an unqualified audit opinion. So there are no qualified opinions, there are no adverse opinions, and there are no disclaimer of opinions. The disclaimer is rare in certain cases or whatever. So within that unqualified opinion, what we're looking at, based on our sample period, because we ended in 2015, we don't have this new expanded audit report model. But what we're looking at is you have the unqualified opinion, which is the 3-paragraph, everything's in conformity with GAAP, everything's okay. And then there's the additional paragraph, and that additional paragraph is going to talk about, well, we have a material weakness internal control opinion, or we restated something in the financial statements, or we changed our accounting policy, or we're emphasizing something else that's very important. And what we're saying is that that additional paragraph is informative to investors. It typically conveys bad news, and that bad news is actually predictive of worse reporting quality in the future. We know that from Scherzny et al., the paper in Accounting Review. So what we're saying is that that is information that's not known to investors until it's disclosed in the 10K filing, and that is material non-public information is what we're contending in this study. So that's what we're kind
But
of
you're
doing in
not
terms of the
classifying
context.
that opinion, right? So you're not categorizing based on what exactly is the changes, whether that change in the policies of accounting or whether that because material internal control
Yeah.
or material, you're not classifying that, right?
So in our primary results, we're not. We're basically just saying 0.
Sure.
Now, here in the paper, we do look at some cross-sectional variation with respect to the content because, you know, like we changed some accounting treatment. Well, who cares, right? That's a lot different than we have a material weakness in internal controls, or we have, you know, a restatement that we're dealing with. We're deeming that to be more material than some of the other stuff. So later on, and I'll get to that here in a minute, but we do bifurcate. We show that what we would classify as the more serious things, we see a little bit more elevated insider trading behavior that would be consistent with them utilizing that information to their advantage.
Agreed. Thank you. Thank you.
Yep. Okay, so this right here is a nice figure, a timeline. So again, our sample requirements, the earnings announcement date has to occur before the audit report date. And then we have to make sure that we have enough time series between the audit report date and the 10K filing so that we can say that this reaction is due to the audit report and not any other, you know, confounding news event. Okay, so our research design, our empirical models here. Okay, so what we're basically looking at is the DV is insider seller. So 1, if the insiders are net sellers on that day, and 0 otherwise. So are they actually trading on that day? Are they net sellers on that day? And then we also look at insider buy, sell, and balance. So we look at the number of insider shares that were bought less the numbers that were sold, okay? So those are our 2 DVs. And what we're basically trying to say here is, okay, so given there's a modified opinion that's coming out, and we're saying that modified opinions will trigger more selling activity or whatever it is, we're saying modified opinion. If you give a modified opinion to your client on the days around that audit report date, so remember the audit report date is the event date. So for the modified relative to unmodified, do we see a more pronounced spike in trading activity around that event window? And we compare that basically to a 30 days before, 30 days out window to kind of get a normalization of trading activity and see if we see a pronounced spike on that audit report date, the event date. Now we include some additional controls like the blackout period, size, book to market ratio, surprise, abnormal returns, and volatility. But we also do something very important that I think helps improve the validity of our study. So in one estimation, we use the pooled with the controls, but the second specification that we use, we include firm quarter fixed effects. So for a given firm in a specific quarter, which is basically firm year fixed effects, we are controlling basically for all the characteristics of the firm, and we're controlling for everything from a macroeconomic standpoint. So all this time and variance stuff is held constant, which extracts a lot of that variation and noise out so that we can actually get in and pinpoint to say, do we see a pronounced spike after holding all else equal around this event window, this audit report date? So I think figures are a good way to convey your results, because if you can show what you're doing in a figure form, it makes it easier for people to understand and everything. So here we have our figures related to our first empirical test. The solid line is for those instances where the modified opinion equals 1. So they had a unqualified opinion with additional language that was included in it. And that's relative to just the traditional unqualified opinion. 0 is the audit report date. And what you can see here is that from the earnings announcement to the 10K, there is a pronounced spike around the audit report date. And then on top of that, that spike is more pronounced for those that have the modified opinion with additional language relative to the unmodified opinion itself, okay? And, you know, another thing to kind of point out here is that we do see that the dotted line, you know, somebody might say, well, if there's no information content in that unmodified opinion, shouldn't we see a straight line for that across the board? Because there's really no information there for management to take advantage of. Well, we contend that there's still information in the audit process itself, right? The fact that maybe they had significant deficiencies that have to be disclosed in an audit opinion, or maybe adjustments that were really close to the materiality threshold, but weren't enough to have to be booked or whatever it is. There might be still some information content where you might see a little bit of trading around that unmodified date. But we think that the modified opinion would trigger greater trading. So,
Joe, hey, this is Phil. I have a question for you.
Yep.
How can you just explain where when the blackout date starts for? I'm trying to think of this spike you're showing around the audit report date relative to the blackout dates for insider trading around the filing of the 10K.
So so typically the voluntary blackout windows go to the earnings announcement date, is my understanding. Is this you, Phil?
Yeah, sorry.
Oh,
yeah,
hey man, sorry, your face didn't pop up or your name didn't pop up. So
here we
it's
go.
great to see you, man.
Yeah, good to see you. So yeah, so I'm trying to think of so the blackout dates for insider trading ends at the earnings announcement, and there's no blackout for around the filing of the 10K. Is that right?
That is correct. And it's voluntary. So technically there really is no rules, but most companies, their general counsels have recommended them to not trade from year end up to the earnings announcement release.
Okay, cool. Thank you.
And then, it's interesting because we presented this, we actually presented this to a corporate governance conference where there were a lot of legal counsel there. And before they're like, this is ridiculous, blah, 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 it's not material. And then somebody else came up and says, crap, thank you for pointing this out. Like, we hadn't even thought about that. We need to go back and look at our policy, right? Because I don't necessarily think this is like nefarious. Well, I mean, I do, in some ways it can be, but like, I think it's just, in some ways people just being like, wow, I didn't realize the fact that there is still some material information that occurs, and that the way things have changed now, you got the earnings announcement coming out before the audit's done. There's still content in the audit reports. So again, like, I'm hoping these results will help kind of inform companies and regulators to just kind of consider this fact that we want to make sure that there isn't any of this, informational advantage that might be getting exploited, whether it's nefarious or.
And you're showing that there's a statistical difference between the black line and the dotted line.
Yes, yeah. Which, so I'll get to the table here in a sec. So,
Cool.
Insiders. What's that, Phil?
Thank you.
Okay, yeah. So you got the probability of insider sales, and then you also have the sign trading and all that as well. So more likely to sell than buy if you're modified relative to unmodified opinions. Okay, so here are the multivariate results behind those figures. So what you can.
There is a question from Wayne. You can.
Okay.
Yes, this is RC from SMU. So I think my question is related to Joe's dissertation about all the completion and earnings announcement. So I wonder whether the result is driven by whether the manager intentionally delay their earnings announcement day, or the timing of earnings announcement or not. So because you intentionally try to focus on the firm whose earnings announcement day is before the audit report, is it related to the managerial decision about timing of earnings announcement in relation to the audit completion date?
Well, so the way we constructed the sample, because we're trying to get a causality, kind of tips that point where like the EA has to come out before the audit report date, and the audit report date has to be 10 days before the 10K.
Yeah, so my point might be whether your result may have some implication on, for example, to the policymaker, whether manager it's better for them to wait till the audit complete their work, or the information is coming from the audit report per se. So
yeah, so a couple of thoughts here, because I've kind of gone back and forth with it. So like if they wait to release earnings until the audit report date, let's say, there's still this informational advantage because they know the content of the audit report before they get to the 10K. So I don't know if that'll fix it, but there's been an increasing trend of companies releasing the earnings announcement the same day as the 10K filing. So about 2% of companies are doing that now. I don't think it's a problem. Those companies, they're not trading and they're releasing EA the same day as the 10K. So I don't think that's necessarily problematic. So that's probably from a regular standpoint, those are fine, right? But for the other 58% that are doing this, you know, we need to start thinking about and looking at, you know, the timing of the earnings announcement. So what about the companies that are releasing earnings really, really early without the audit being done? And why are they really, really early? Is it because they're trying to get information out there timely to investors, or something that you might be suggesting here is that, or are they purposely doing that so they have an informational advantage? I don't know, right? They're just get it out so the blackout window is done and I can start trading, right? And those are, I think, some additional follow-on questions that might be kind of interesting in this, I think, stream of research, right? It's what's the intent of that?
Yep. Thanks for your response.
Yep, no problem.
Joe, please, do you have going concern opinion in your sample?
We do not have going concern opinions in our sample. The reason why, so original version of the paper did have going concerns in there. We didn't have, based on our criteria and stuff, there weren't that many to begin with. I think we lost like maybe, I don't know, like 40 observations or something, excluded them. And because of the prior research, remember I brought up the Hallman paper, you know, we had some pushback in the review process of like, well, maybe, you know, the going concerns are different. It's about bankruptcy. They're very salient events, so it might just be adding noise to the research design. So we ended up taking them out. Now, if we include the going concern opinions, the results are relatively the same, but we don't include going concern opinions in here. So,
Thank you.
Yep, no problem. Okay, so back to our research design here. So what you can see here in columns 1 and 2, we're just looking at do they, you know, sell on a given day or not. And we can find that it's more pronounced for modified relative to unmodified opinions. And of course, the results I think are quite robust because, you know, when we include the firm quarter fixed effects, which is a very strict research design, we still find the results come through. And then in columns 3 and 4, we also show that they're more likely to sell relative to buy for the modified opinions relative to unmodified opinions. So we think that the evidence here seems to be very consistent that around this audit report date, which is an informational event or the proxy that we're using for when they're communicating this private information, we're seeing a pronounced spike in behavior by management. And it's more pronounced for the modified opinion, which we think would, you know, have more negative information relative to the unmodified opinion. Okay. All right, so that's our primary result that we're really excited about. But, you know, I think in any type of, you know, investigation or whatever, you have to sit back and say, okay, well, we've documented this phenomenon, but is it really nefarious or not? Or is it really insider trading, you know, based on, you know, the audit report itself, or are we just picking up some sort of random trend or something right after the earnings announcement? So to triangulate our evidence towards our research question and our story and our big takeaway, we do a series of 3 placebo tests. So first, we're going to look at trading activity at the 10K date when the audit report is public. We're going to look at insider trading around the Q3. And then we're going to look at the public stock market reaction around the audit report date itself. Okay. So trading activity at the 10K date is, do we see any insider trading for these companies that have modified relative to unmodified opinions? Are they actually engaging in insider trading when the audit report date is made public to everyone? So if our story is correct, they'll trade, you know, when the audit report date is there, when they get the private information communicated to them, but they won't trade when it's publicly available to everyone else, okay? We also look at insider trading around Q3. Now, Q3 is not audited. It's a review. So there really is no private communication from the auditor. I mean, of course, they have a review that occurs during Q3, but it's not to the scope or level of the audit. And then on top of that, there is no review report that's released with the Q3. So let's try to simulate the process with Q3 and see if we see any type of trading behavior or activity there that would be consistent with them having a private information advantage and exploiting that private information advantage. If we find it in Q3, that would really kind of contradict what we're trying to say we're finding with Q4 results with the 10K filing. And the last one is looking at the public stock market reaction on the audit report date. Now, remember, the audit report date is not going to be known until that audit report is released to the market with the 10K filing. So the question is, do we see a stock market reaction on this report date that's not known? This event is not known to the public. If we see a stock market reaction on that date, well then, insiders aren't really having an advantage or anything because the market seems to be aware of the content of this event. But if we don't see a stock market reaction, then that would suggest that, yes, this is private information that might be used by management or directors. So in the first test, what do we find here? Insider trading around the 10K filing. And what we find here is there really is no trading activity that we can pick up around the 10K filing date. So it is consistent with the insider trading spike being on the audit report date, the private information event date. Looking at Q3 as a placebo, and we use kind of a makeshift audit report date based on the timing of when the audit report date comes out before the 10K filing and the EA. We kind of signify that there, but we don't see any pronounced spikes or anything like that with insider trading that occurs during Q3. We only see these spikes during Q4. And the last one is we don't see a stock market reaction on the audit report date itself. And this is important because this shows that the market is not aware of this information event and they're not trading around that time. So when we see a pronounced spike in insider trading, they're trading and nobody else is aware of the information. At least that's what we would interpret this evidence as suggesting. Okay, so one other thing we do here is we look at, right now we're looking at the 5 days around the audit report date as the event date. But we also decide to look at some alternate windows to kind of see trading behavior. Is it happening 5 days before the event date? Is it happening 5 days right after the event date? 10 days after the event date. Remember, the audit report date is a proxy for when this communication occurs. Now, I want to make sure everyone understands that there could be constant communication occurring. Maybe there was meetings right before the audit report date or after the audit report date. So the audit report date is merely a proxy, okay? We think it's a decent proxy for purposes of this study, but there could be other communication windows. So we want to look at these additional alternative windows to see if the trading behavior is more pronounced right at the audit report date versus other windows. And what we can see here is not a lot of really activity from -10 to -6. We do start seeing a pickup in trading behavior from -5 to -1. But the most pronounced trading activity is occurring from days 0 to 5 days after the audit report date that we use for our event date. And we do see that trading does continue 6 to 10 days after, but again, it's starting to be less pronounced than it was in those 5-day window. So again, I think what this shows us is that the trading activity seems to be very concentrated on the audit report date. That's where you're seeing a lot of the activity, but we do see some in these alternate windows as well. Okay, so now that we've done placebo tests to kind of, I think corroborate our results, the primary results, we now transition into kind of the second phase of the paper that we're really excited about, and that's who's trading, right? So I think we've established that we have evidence to suggest that this is happening. So let's try to figure out who's doing it. Is it management? Is it the board of directors? If it's the board of directors, who on the board of directors is doing it? Okay. So again, replicating our same research design. We're also including these different windows to see when the trading is happening. And what we're arguing is that it's possible that management has knowledge before the board of directors. Remember, management is interacting with the audit on a day-to-day basis, whereas the board of directors will show up for the board meeting and the auditors will then provide those required communications to the audit committee and the board of directors at that point in time. So it is possible that if we see insider trading occurring, management might be doing it before the board. And then on top of that, within the board, who is actually doing it, okay? So right here, we look at the insider trading behaviors of officers, executive management. And what we see here is that their trading behavior starts 5 days before the audit report date and then continues to 5 days after the audit report date and then 5 days after that. So it does seem to suggest that management starts their trading 5 days before the report date. So this would be suggestive, or at least the way I would interpret it is that management does have this private information and they might start capitalizing on that until the formal communication that might happen with the board of directors. Now, when we turn to the board of directors, we see that their trading behavior or their trading does not start until right after the audit report date. So this is consistent with the audit report date being that communication event, at least for those board of directors. And we're seeing that that communication is occurring after the audit report date itself. Now, I find this interesting to me because it shows that management has this private information and they're gauging on it before the directors, okay? So they're having an information advantage relative to the directors, and both of them seem to be engaging in this trading behavior before investors find out. Now, the next question is, who on the board is doing it? Now, the board consists of a lot of different insiders, outsiders, all this other stuff, but I kind of look at the board as this. You've got your audit committee, which is really responsible in ensuring high quality reporting and safeguarding of assets and governance and all this other. So these are your accounting experts, your financial experts, people like CPAs or accounting professionals that really should understand the securities laws. And then you got the other board members that are, they're great people.
Joe?
Yes?
Philip, I have a question. There's a question.
Yep, sure.
So, sorry, finish your thought and then I'll ask my question.
Okay. Okay, I'm teeing this up for you, Phil. So what we find here is that audit committee members don't seem to be trading, but non-audit committee directors do seem to be trading. Okay. So the way I interpret this, at least for me as a CPA, I'm encouraged because I don't think audit committees, these are your financial experts. They should understand insider trading laws. So this is consistent with them kind of, hey, I'm not going to do this, right? Or at least I'm aware I shouldn't trade until maybe after the 10K or whatever it is, right? But your non-audit committee people, they might be getting communication of results that are occurring on the audit report date, and they start engaging in trading. So the totality of this says that management's doing it, board's doing it, but it's only the non-audit committee members on the board is the big difference. So Phil, what's your question?
So my question is on interpretation of kind of the big picture result. So you're showing that managers are trading in this window where there's supposedly information from the audit report. That presumes then that managers believe shareholders or investors believe that it's going to be informative at a later point in time. So or investors should be trading or behaving in some way once the information is made public. So does the insider trading, and I haven't read the whole paper, does this insider trading behavior lead to some form of investor response, meaning that the insider trading is predictive or the insiders accurately predicted investor responses? Alternatively, is it that investors or managers are, I'm an audit researcher, so I don't want to, rain on the parade, if you will, but is this, alternatively, is it indicative or suggestive that managers think the audit report is informative, but in fact, if investors are not responding later on, it's actually not informative. So it's a misunderstanding by managers and directors, and the audit committee result could be interpreted as the audit committee doesn't think this is overly informative because they have an accurate interpretation of the audit report, and therefore they're not trading because they don't think it's informative. Just a thought, big picture.
Okay, yeah, no, I mean, that's definitely, that's like the next step, right? To say, like, is this actually predictive of stuff? Or so, like, at the end of the paper, what we do is we do some exploratory analysis to say, does the insider trading behavior predict restatements? And then based on whether a company is likely to have a restatement, do they profit more, right? Because, this stuff is going to eventually come out. So you're right. Could be investors just don't care about the audit report. And trust me, I've had an existential crisis of thinking about why did I work 5 years, 3,000 hours a day, a year, like all this stuff when nobody cares about it. But we do some additional analysis at the end because I think that's very important to establish that fact, right? Is this actually, do they benefit from it? I guess is what you're getting at from your question, right? So I'll get to that here in a sec, but I mean, you're right. It could be that management thinks, but then it doesn't react. But you would think that, I guess, in a repeated game, like, second time this occurs, then they wouldn't do it, right? So I don't know, maybe we could look at repeated game type stuff or something to see first time versus second time, to kind of rule out your concern, possibly.
I think it's a very interesting study. I think I'm trying to think kind of the big picture interpretation.
Yeah.
Very cool.
No, that's helpful because it's, again, we're trying to, this is different type of research in my view, right? I mean, you have the theoretical kind of positive theoretical approach of trying to understand the way the world works. Here we were sitting here just saying like, wow, they have a private information, do they exploit it? And then we're looking at all evidence to try to come to a conclusion on whether this is actually happening or not, right? So just kind of going down this, I don't know, Sherlock Holmes approach or something, and trying to rule out everything with evidence and then take the totality of the evidence together to make your case, right? So, but anyway, so, circling back here to the results, looking at the board, I think, I find this pretty interesting and how this came out. Management's doing it, the non-audit committee members are doing it, but for some reason the audit committee members are not engaging in this. So back
Excuse me, Joe,
yep.
Yeah, just to be sure, for your independent variable, is it the cumulative abnormal return to capture market reaction?
What was that again?
So for your independent variable of interest, is it the cumulative abnormal return or any variable that is used to capture the market reaction? Your independent variable.
Yeah, I think it's a 3-day market reaction around that.
Yeah. So just maybe take me to a question which is related to Philip, maybe. And based on my understanding, I'm not aware about insider trading, but my question is based on what I understood, that insider trading is done by the management. So do you think that management trading, which should be for small number of traders, can be sounded and reflected in the market? So for small number of traders, is it enough to be reflected and sounded in the market? This is my question, and based on my understanding.
So are you saying, is this a big enough deal?
For my, again, insider trading is not my research area, so
okay.
I have not enough knowledge, but just in a naive thinking, I'm saying that if we consider that each company has board, and if we consider that all the board is trading, I think this is not that number or this number is not that big to have to be reflected in the market. This is based on my understanding. I might be wrong.
I kind of go back and forth on this. It's okay, fine. Management has this information. They're going to trade. They're always going to be informed. Or
maybe sorry for, or do you think this is maybe or do you think, for example, there is a leak to the market, so there is private information for management, and before the filing of or before the signature of the report or something like this, this information has been leaked to the investor or anything. So the idea is that to find that impact on the market, so I think it needs a number or a number of tradings. So yeah, I'm not sure how to interpret this.
Well, so are you trying to get at like economic significance, or?
Yeah, yes, or not only economic significance. I'm just thinking if just we consider the trading by officers or by management, the number of trading is expected to be small. And the question is, can we imagine that the small number of trading to be significantly
to the overall market?
Yeah. Yes, that's my question.
So to me, so the rules are the rules, right? I want to make sure that everyone is playing by the rules. And, if you cheat a little, it could lead to cheating by a lot, right? So I believe that insider trading laws are important. And, there's research that shows that, and this, I forget which paper it is, but in one of the finance journals, it shows that CEOs will engage in insider trading and it's not profitable to them, but they'll still do it. And it's just this innate thing that, like, I have the information, I'm going to trade on it, even if it's not going to make me millions and millions of dollars or move the market. But the thing is, we got to think about tone of the top. We got to think about the rules and making sure that there's a level playing field. So to me, I think that if we're seeing evidence so consistent with this, then we need to come in and we got to make people aware of it. And we got to try to squash it, because the last thing I want is something small, maybe in your eyes. I think this is a big deal, but something that might maybe be smaller could then mount up to something bigger at some point in time and cause some problems for the U.S. economy and stuff, or the global economy. So that's kind of my mindset here. So I don't think management should be taking advantage of any type of material non-public information. And I don't think directors should be doing it. And, that's why this type of research is important, to looking at these material information events and then determining if people are taking advantage of it. And I know Dan's had a series of papers that have looked at these different types of events to see if this is being exploited. And this is the type of thing that is very important to the SEC. We actually had the chance to present this paper to Commissioner Robert Jackson when he was still on the board. And, they're concerned about this stuff. They're concerned about people taking advantage of these things. And with more technology and more, we can try to put together a better resource and tool to identify things that people might have been getting away with in the past that hopefully here in the future, they're not going to be able to get away with. And this could be easily rectified if we just kind of say, hey, be aware of the fact that the audit contains maybe some material non-public information. And let's talk about maybe, extending the blackout window to the 10K and just make sure everyone has a level playing field. So
just to follow up here, I don't think, I don't think your message is mainly that this is going to affect the overall market. It's mainly, you're saying that this is actually illegal and should stop, and people should not, take advantage of it. So one way to look at that and try to look at the economic significance is to try to kind of standardize the value of the trade to the compensation of the officers. And in that case, you're not reflecting that this is going to affect the market, but this will affect the overall wealth of the managers themselves or the directors in that case.
But they kind of quantify it. But, even then there's been research that shows that CEOs and stuff they'll engage in this type of behavior, even for stuff that we would deem immaterial to them. They're still engaging in that behavior, so that's something to also consider,
But Joe, given that you're trying to sell the paper as kind of abuse illegal insider trading stuff, the whole literature in insider trading is divided between whether it's a signaling story or whether it's trading on private information and abusing the privileged position. And given your results on especially the restatements, maybe you actually have more stake in the signaling literature than trying to sell it as in some sense abusing the private or privileged position. Because as you say, they don't really make a lot of money of it. Your main variable here is looking at the volume, changes in volume. And also if you look at number of transactions per insider per year, I suppose you've got a very low number. Yeah, you've got 113,000 observations within 35 plus years for 2,000 plus companies each year. So if you look individually at how many trades were executed per insider, then you have very few trades per person per year. So I think being on the insider trading side of the literature, I feel there is a lot more to signaling with your restatements than to abusing privileged position.
So talk about the predictive ability of it.
There is a controversy whether insider trading is good or bad.
Yeah.
And signaling is on the side that maybe it's not damaging the market, but it actually enhances the market efficiency. Because, I don't know, the way the way you at least talk about this paper is about insiders abusing their position.
Or taking advantage, right?
Or taking advantage, but it's got a kind of pejorative tone to it. And
well, I mean, my view on that, there is the signaling component where there's insider trades and stuff, that try to signal to the market that, hey, maybe you're misvaluing us and all this other stuff. But sitting here and pinpointing it directly to a non-public, material piece of information, that's when that signaling, which is a good thing, I think starts tipping the scale into something that might not be as good, right? So I get your point. I'm trying to reconcile it into the setting and the context that we're looking at, right?
Because as you say, the people who are mostly informed, they don't trade on this information. Yeah, so it weakens your current argument in terms of abusing their privileged position, and that's obvious because if you're closer to be in a legally difficult position, then obviously there is again insider trading literature that shows that you withhold from trading. And maybe I didn't think about it, but maybe looking at your setup, looking at who withholds from trading.
Well, yeah, I mean,
it would be an interesting setup as well that you could learn actually.
Well, I think, ideally what we have here is we start developing tools that show here is trading pattern that seems to be inconsistent with just normal signaling or whatever it is. And it's actually, advantageous on the part of them using their insider information. I think that's where we have to go. And I think you're right. There are cases where this is happening and people aren't doing it, and we're documenting the ones that are doing it. The other thing I have to put as a caveat, our strict research design, we're not looking at a whole lot of companies. We have to have it fit in to try to get a more causality. But if we were to explode it up to a larger sample, we could look at trading patterns and say if there's a pronounced spike after the earnings announcement, that's probably when communication occurred. And then we can start looking at, okay, well, this is what's happening. This is the type of audit opinion they got, and then use that as a analytical tool for regulators and auditors and different people to use to say that might be something you need to look at or reconsider in your risk assessment process. So, I mean, ideally in the long run, that's the type of stuff that we as academics should be striving for, right? And we kind of see this first step here as just kind of pointing out, this situation and helping us all collectively brainstorm ways to identify it and rectify it, I think, going forward.
Well, you could also look whether the traders are opportunistic or routine, yeah?
Yeah, exactly. I think you're right. I mean, we could go drill down in and try to get to that next layer like you're recommending. So,
Joe, can I jump in there?
Yeah, Dan.
So, signaling is a good alternative, I think, in sort of broad cross-sectional samples. But here, I think what we got to keep in mind is, and I think there's a placebo test somewhere, maybe Joe will or won't get to it, where there's no change in volume or prices around the audit report date. So if this was insiders trying to signal through their trades, dumping the shares, it's not successful because you don't observe market prices or market volume changing around the audit report date. Now,
but then if you go back to Abudi and Kashnik paper on R&D and insider trading,
right,
it's not about changes in stock prices and about volume. It's about signaling changes in R&D expenses.
Right, but you would expect.
So you've got here the restatements. Yes, the signaling would be about restatements.
Right. So you would think that would be a bad thing, and you would think that when you observed insider trades, the Form 4s, that would get impounded into market prices. But what Joe's going to end up showing is not only do these these predict restatements in the future, they're not impounded into market prices today, but what's interesting is that we actually calculate the insider's alpha. And we show that it gets into returns over the next, 180 days. So if it is signaling, it's not a efficient market response. Because if it's
not an effective signal. Yeah.
Right. If it was an efficient market response, you'd see everything jump into price when the Form 4 gets released, not 6 months. 6 months later. So yeah.
And I mean, and I get your point on the signaling, argument. But like here, it's just this is material non-public information. We're trying to figure out if they're capitalizing on it. Are they profiting on it? Is it consistent with more bad news than maybe good news? And the totality of the evidence would suggest this is not a good thing, right? And I think that's kind of the point of the paper, is just kind of do an investigative study on this particular situation, highlight it, and then we can hopefully, as academics collectively, start working towards, remedying these things. I think that's kind of the, my view as an academic is not just to write the next paper, it's actually starting to, help society and bring the results collectively together, I guess. So, but yeah. All right, so back to the study here. So we look at the different types of modified opinions now and see if if there's any more pronounced trading based on the content of the audit report itself. So we look at like first time modified opinions. We look at modified opinions that are associated with future restatements, and see if we see more pronounced trading activity there. So what we see here, so the whole idea here with this modified first time opinion is that, and I think a comment we had earlier was about like, is this the first time? Is it not the first time? If it's the first time, then we would contend that this is, more of an informational advantage to these stakeholders or to the management and board of directors. So we probably see more pronounced insider trading activity. If they're getting like, let's say, a repeat material weakness opinion, the market is already kind of aware of this information. It's not really, beneficial information to the insider. So we may not see as more pronounced trading activity. What we can see here is that our action is in the modified first time and not necessarily as much with the modified not first time activity. So again, this is consistent with, this informational advantage relative to the market, and they're exploiting that information or taking advantage of that, informational advantage. All right, so moving on here, we're looking at companies that will eventually have a modified opinion where that is involved with a restatement. And what we can see here is that they are more likely to engage in insider trading activity relative to those companies that do not eventually have a restatement. So again, we take this, evidence is consistent with, they have a informational advantage and they are taking advantage of that informational advantage. Okay, so the last things here, as Dan was mentioning, was, okay, well, let's try to get at opportunism. All right, so some tests of opportunism. So before we're showing this trading's happening, we're showing it's more pronounced when the information advantage is greater. We're showing that management's doing it, non-audit committee members are doing it on the board. But does this matter, right? So like, are they getting benefits from it? Because yeah, great, you have an informational advantage, but if you can't unwind that and take advantage of it, then it's, it's not that big of a deal, right? So here is our attempt to look at, are there situations here where the insider trading predicts future events. So the first one is, do insiders trades predict future restatements of the current period? And then the last one is, do insider trades predict kind of future stock returns related to this informational advantage that's occurring? All right, so right here, we're using kind of just a standard restatement model from Armstrong et al. And what we're looking at is, do we see that the insider trading behavior predicts the likelihood that this year's financial statements contain a material misstatement that's restated during future periods? So does it predict that future restatement of this year's financial statements? And, I think the first thing that I'm excited about, because there's the Chersney et al. Paper, and we're showing that modified opinions are associated with it. So we're kind of corroborating prior research there. But then we're also showing that insider selling behavior around the audit report date is predictive of an increased likelihood of a restatement in the future. So remember, again, this is a modified opinion that's being released. They're issuing their 10K, and then in the future, there will be a restatement of that 10K. And we're showing that their trading behavior is consistent with predicting that future restatement. I think that's a very interesting result, that the actions management's taking with respect to this, audit report and all this other stuff is predictive of this future restatement, this future event. So it does seem to suggest that they're doing it, and they're doing it because they maybe don't know at that time there'll be a restatement. There's maybe some uncertainty or something that they're doing it for, and it might be to try to avoid certain losses in the future or whatever. And we're also showing that insider selling in the prior year doesn't really have much of an effect. So, this is pretty interesting, I think, evidence. I know when we as a team did it, we were like, wow, this is very interesting. This is something we added to the paper in various iterations of revising it. We also show the same case here with the buy, sell, and balance, again, predictive of the future restatement. And the last one here is getting at, do insider trades predict future stock returns, avoid losses, do they benefit by trading and all that? And what we're looking here is, trades without a restatement, trades with the restatement. So trades without a restatement are like they're trading, but there's no restatement in the future. Trades restatement in the future, and then we're looking at the modified opinion versus unmodified opinion. And looking at their window sales related to the industry benchmark, looking at it related to their own benchmark in terms of their own trading activity in the past that doesn't reflect the actual period of question. And we show that they're benefiting. They're more profitable. They're avoiding more losses, which is seems to suggest that not only are they trading on this information with the modified opinion coming out, but it is actually benefiting them in the long run. And that's, of course, over an additional 180 days after the sale. Okay, so in 180 days afterwards, they were in a better position based on what they did from their trading behavior. Where are we at on time here? Okay, so in summary, just to kind of, I think, pull it all together, this is I think, an interesting thought exercise that we as a team sat down and said, okay, this is the way the world works. And the way the world works with the audit process, it is going to lead an informational advantage to management directors. Now, the next question is, are they taking advantage of that informational benefit that they have through the audit process? And what we find in our primary results is that, yeah, we do see an increase, spike in insider trading around the audit report date. We find that it's more pronounced for the unmodified with additional explanatory language relative to the unmodified. So this audit report contains an additional information that's new to the market. We see that the trading is more pronounced. We do a series of placebo tests to show that this is actually private information by showing there is no market reaction to the audit report date, public market reaction. We show that insiders aren't trading around the 10K release date. It's actually the audit report date before. So that's a private information communication. We're showing that it's in Q4, not Q3. So all these placebo tests seem to suggest that they are taking advantage of this for a reason. We do some additional research to show that this is more, it's done by management and it's done by the non-audit committee members, which I think is very informative to who's actually engaging in this trading. And then we also show that it's more pronounced when the information is more meaningful, right? So looking at the different content of the modified opinion and seeing that, more, I guess, negative information that would be in there, you see that the trading behavior is more pronounced. And then, of course, we also show that that these insider trades predict future restatements. And we also show that they are able to benefit in terms of their trading behavior over the next 180 days. So when you kind of pull this all away, the absence of public capital market reaction, spike in insider trading activity, we think that this is a significant internal information event at the audit report date. And it does seem to suggest that corporate insiders are taking advantage of that informational event. So what are some of the implications going forward? Well, I mean, I think we all kind of have to think about the audit process. I think audits provide a lot of great things, but it also provides a temporary information advantage. And because of that temporary information advantage, so we talked about it, not everyone's going to take advantage of that, but there are some people that will. And then the question is, are they doing it intentionally or are they doing it unintentionally? When we presented this paper at a corporate governance conference, we had several corporate counsel people come up to us saying, thank you for this study. It's making me rethink, our kind of insider trading policies, and maybe we need to adjust those insider trading policies to make sure that we're not, trading on maybe, information related to the audit report and understanding that aspect. So that was actually really rewarding to hear that at these conferences, that this research is causing people to rethink it. when we presented it to the SEC, again, having them rethink this informational event and all this stuff. And I think that's the starting block of making sure that people are aware, so that we can kind of go towards, I think, the overall quest of trying to mitigate and reduce insider trading and level the playing field for all investors out there. So I think very important. The other thing here is that with the PCAOB expanding their audit report now, last year was the first year for large accelerated filers. Everyone else is going to comply this year. The audit report, we showed that this is happening with just an additional paragraph under the old regime. This new audit report is going to be very robust. It's already very robust. We've got, a lot of research out there showing that the critical audit matters and the different paragraphs are being added to it. With this additional language comes more information advantage, because you know what the content will be before the investors, and there's more information there. So again, just being aware of this, the findings of this paper, to just make sure that we're keeping tabs on this, to make sure that people aren't taking advantage of that informational advantage. So with that, I guess that's thank you for this. So I guess I'll open it up for more Q&A.
Thank you very much, dear Professor Joe, for your contribution and your effort. It's really very interesting presentation. Thank you very much. If there are any questions, anyone, if you have any questions, you can open the mic and ask your question.
Yes, John. Excuse me. So since the one of your of this study implication is its relation with the expanded auditor reporting, which will be starting in the US by this year, may I ask about your opinion about the impact to the market? Because after the study of Guterres et al. 18 and Lennox et al. 19, showing that there is no impact on the market, do you think there is any more to do in respect of the expanded auto reporting? And also, I invested that Adriana is also have some research interests about this area, and also Tariq. So if they would like to participate in giving any opinion about the expanded auto reporting research to the market.
Well, my characteristic, I'm familiar with a lot of those papers. I've discussed them, I've reviewed them and all this stuff. And I think that it's really great. It's great research in the sense that they're looking at this new expanded audit report and saying the information content itself, is that actually incremental to what was already being disclosed? And kind of the takeaway from that research is that when, like in the UK, for example, they pulled out this new audit report, even though they were increasing their disclosures, their CAMs, KAM, it was really like, if you looked at the words, it was about 86% consistent with what was already being provided by management. And some of the early stuff here in the US is kind of, Miguel Minuti Meza, myself, we wrote like a comment letter, and they're doing some preliminary research in the US markets. And again, they're finding not much of a market reaction. They're not really disclosing a lot of CAMs, not a lot of incremental information. But that's like an on average effect. And I think the next phase of the research in that area is starting to look at, well, what's management doing with the disclosure? Are there some, within that disclosure, are there some that have more meaningful content relative to others? Again, the research is this on average effect. Can we look at the distributions of that, and then seeing within those pockets, are they, maybe engaging in insider trading behavior? Is it more pronounced, right? So when I say that this is potentially problematic, I'm thinking about cases where there's more negative information in there, and you could look at the linguistic properties of that audit report and then see if you're seeing an elevated increase in insider trading activity, right? So I think that's kind of, that's where what I'm saying in terms of insider trading fitting into that literature. But to me, it's fascinating. And I think there should be more research in this, expanded audit reporting model. I think Nathan Goldman was on here. He has an interesting paper and showing that, the saliency of tax positions is actually changing tax reporting behavior, with this whole new U.S. critical audit matter, paragraph. So that's a case where, CAMs actually are changing at least tax reporting, right? So maybe investors aren't reacting to it, but it is changing management behavior. So there's a lot of, I think, opportunities to research in that area. So
actually, Doctor, I have a question here, please. Do you think that like auditor independence play a role here? Like my idea, if the, for example, if the auditor is not that independent, so maybe the manager or the management already expect their opinion, so their insider trading will not be affected that much.
You know, so in our research design, by putting in the quarter times year fixed effects, we extract out a lot of that variation. But you know, I think maybe the next step would be interesting to look at some cross-sectional cuts to see, you know, can we get a better measure of tone at the top, or the, you know, who these managers are, and see if they're the ones that are more, you know, crooks or whatever you want to call it, are more likely to engage in this. That might be a next natural extension of the research in the area. And as far as audit, you know, I want to say here, this is interesting because like the auditor is just involved in the audits. I don't think they've actually thought about the fact that this could be private information that could be beneficial to investors. I know, or to management in lieu of investors. You know, the conversations I've had with them when I talk about this study, they're like, huh, I never thought about that, right? And it was the same response I had when I was talking with Dan at the PCA conference, where I was like, huh, I never thought about that. I hope they're not trading on that. So again, you know, I don't know if auditors are fully aware of it. I know that PCAOB guidance tells them to look at insider trading behavior as a mechanism to measure tone at the top. But yeah, I think you're right. I think it, you know, there's some interesting angles you could look at, you know, to see the characteristics of companies or characteristics of company management or the auditor itself in terms of, you know, their enforcement role or oversight role of their clients, and whether you see this happening more or less often. So, yep.
I have one question. I just want to ask the, okay, based upon your study, you said there's a spike in the trading in, I think, towards the audit report, right? So what if there is a significant major announcement quite near the date of the audit report? So would that affect the results? Did you control for that?
I mean, first off, you know, yeah, I guess if there's a confounding news event on that audit report date, that could be the case. Now, I'm going to hang my hat on the fact that we're not seeing an external market reaction. So, you know, we're seeing the pronounced spike, but there is no market reaction on that event date that we utilize. So I would assume that if there was a confounding, you know, event that was occurring, that would have to be like an 8K disclosure or something that would then be publicly disclosed. And we're not seeing that with the market reaction. So that would kind of, at least for me, reduce my concern that that's what the case is. But I mean, it's a good point. You know, I think in any research, you need to think about confounding.
Actually, I mean, I do get your point, but what I'm trying to say is that I'm not talking about market reaction. I'm talking about usually for insider trading, when, let's say, some major announcement happened. I mean, the insider trading happened before that. And of course, the market is not aware of that. But what I'm trying to say, the private insiders did trade on this before this major announcement. So if your audit report is actually quite near this significant major announcement, so, yeah, so that could, I mean, affect your research result. Am I right? So that's why I said you control for all these things. You know.
Well, I mean, our research design, we're outside of the EA window, so it can't do that. So it'd have to be some other announcement that's occurring after the earnings announcement. So, I mean, that's something we can consider. So.
Okay. Thank you.
Any Bombay, you have a question?
Good afternoon, sir. I'm from Mumbai. I'm working on classification shifting, earnings management classification. So can you let me know what can I do in that one more?
So you're working on, again, sorry, I'm trying to understand what you're doing.
I'm doing some work on classification shifting, earnings management. How do these auditors, they window dress, like that kind of thing. So what can be done on that so I can publish?
Man, if I could get things public, I've been on a track record of rejections right now. So if I had the magic equation, I'd tell you. But I think, you know, what I've always found interesting with classification shifting when you think about like Sarah McVeigh's dissertation, I think is kind of the seminal work in that area, 2006, is showing that there's this classification shifting that's going from core earnings to kind of these below the line items, shifting expenses and everything. And what's remarkable is that the auditor should be, at least when I audited, we were told to look at these classifications because it's important, because if they have discontinued operations or one of these below the line items, the risk is that they're going to shift core expenses down into that to make their operating income look better, right? So, one interesting angle that you could be looking at there is, like, what is the governance mechanisms that are in place? Do you see it's more pronounced for companies with weaker auditors, weaker corporate governance? Why are auditors missing it? Like, are they just fixated on bottom line net income when they're auditing, and they're losing sight of the fact that classification buckets are very important? So those would be things that I've always found interesting that you might consider. Maybe, insider trading as well, depending on whether, investors focus on street earnings relative to bottom line earnings. So.
Thank you, sir.
Yep.
I think that you have done very well with answering a lot of questions there, dear Professor Joe. So thank you very much. Ended so all that remains for me to say thank you everyone that joined us, and I thank you very much for taking the time out to present to us today, dear Professor Joy. It's really been appreciated. Thank you.
Yeah, well, and I just want to reiterate how grateful I was to have the invitation and the opportunity to share a very important paper that we've been working on. People around the world, this is great. I'm seeing a lot of familiar faces and friends on here, and keep on doing this, Mohammed. This is a great thing that you guys are doing, and maybe next time I can actually come out to Egypt. So
thank you very much. Welcome to Egypt. I hope to see you soon in Egypt. Thank you.
Take care, guys.
Yeah, thank you, Joe. Thanks so much.